All right, let's dive right into this explainer. I'm your host, and today we're putting on our forensic accounting hats and acting as your dedicated, highly skeptical equity research desk. We are ripping open the 10Ks, the 10Qs, and the earnings call transcripts for Koppers Holdings, Inc., trading on the New York Stock Exchange under the ticker symbol KOP. Look, this is a hype-free, entirely data-driven zone. We really aren't interested in management's rosy PR spin. We are here to uncover the objective, ground-level financial reality. But first, let's get the mandatory housekeeping out of the way. Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. Okay, let's get into the numbers. 10 to 15%. Think about that for a second. That is the massive free cash flow yield that Koppers management claims they're generating relative to their current market cap. Now, in the industrial materials sector, a free cash flow yield that high usually means one of two things, right? Either you've stumbled upon an incredibly misunderstood, undervalued cash machine, or the broader market is pricing in a massive impending disaster that you just can't see yet. Which brings us to the central paradox of this explainer. Is Koppers an undervalued cash machine just waiting for a major re-rating, or are we looking at a deteriorating value trap? How exactly do we weigh this supposedly incredible cash flow generation against a backdrop of persistently sluggish declining sales? Because as an investor, you really have to look past the flashy headlines and dig straight into the cold, hard numbers. Now, take a look at the sheer contradiction in their recent Q2 results. It's fascinating. On the top line, sales absolutely plummeted by 10.4%, dropping down to $505 million compared to the prior year. Demand is demonstrably sluggish across almost all their operating segments. But then drop down to the bottom line. Their adjusted EBITDA margin, which is essentially their core operating profitability, hit 15.3%. Guys, that is an 8-year high. They are literally shrinking their revenue footprint while extracting record profitability from what actually remains. Before we dissect exactly how they're pulling off that margin magic, let's ground ourselves in what Koppers actually does in the real world. They operate at the foundational, totally unglamorous layer of the economy. They provide treated wood products, think heavy-duty railroad ties and utility poles, along with specialty wood treatment chemicals and carbon compounds, like coal tar pitch that's used in aluminum smelting. It's highly essential infrastructure material with a massive, heavy physical footprint. So what's the secret behind those record margins despite falling sales? It's an aggressive multi-year restructuring plan they've dubbed the Catalyst Program. It was launched to ruthlessly cut costs, and the biggest driver of future earnings here is actually the wind down of their Stickney, Illinois facility, which wraps up by 2026. By consolidating that production all the way over to a plant in Denmark, Koppers is projecting a massive $1 to $1.20 earnings per share boost by 2027. Ultimately, they're targeting $80 million in ongoing annual benefits by 2028. We can actually see this aggressive cost containment in action right here. They have intentionally slashed their capital expenditures. That's the money spent on maintaining and buying physical assets, managing them down to a super tight $52 to $58 million target. The crucial takeaway here is that by essentially suffocating CapEx and driving operational efficiencies, they're forecasting a massive $175 million in operating cash flow. The ultimate goal? Generating well over $300 million in cumulative free cash flow over the next 3 years to rapidly de-risk their entire balance sheet. But look, as forensic investigators of financial statements, we are trained to hunt for discrepancies. And here is our first major head-scratcher. On the green flag side, the company is aggressively buying back its own shares, over $38 million repurchased recently, and they've hiked their dividend by a solid 14%. That usually signals supreme corporate confidence in their cash flow. But the red flag? We've got SEC filings showing significant insider selling. CEO Leroy Ball and Senior VP Stephen Lucas have collectively dumped thousands of shares worth hundreds of thousands of dollars. When the corporate treasury is buying, but the C-suite is actively selling, it really begs the question, who truly knows the future of this company better? And, this internal contradiction extends right down into their actual business segments. The massive green flag is surging secular demand in their utility pole segment. Why? Well, because AI data centers, crypto mining, and EV infrastructure all require massive foundational electrical grid upgrades, and Koppers supplies those poles. But the stark red flag is their carbon materials and chemicals division. It is in absolute turmoil right now, fighting highly volatile global coal tar costs, fluctuating oil prices, and even a key raw material supplier abruptly exiting the market. Let's speed things up a bit and objectively fire off the 7 deep red flags buried in these filings, stuff the media totally ignores. 1. Sales are objectively declining year over year, which is simply too boring for a flashy headline. 2. That C-suite insider selling, often buried deep in Form 4s where most retail investors don't look. 3. A somewhat elevated net leverage ratio of 3.5 times, a math reality that usually puts mainstream pundits to sleep. 4. Structural turmoil in carbon materials, which is way too complex for a quick TV soundbite. 5. High effective tax rates hidden deep in the footnotes. 6. Railroad customer consolidation, which isn't exactly as sexy to talk about as artificial intelligence. And 7. Projected severe winter weather and shipping disruptions in Q1 2026, which is just too far out for the 24-hour news cycle to care about. But hey, we have to remain perfectly objective here, so let's pivot to these 7 overlooked green flags that are quietly strengthening their balance sheet while the market looks the other way. 1. Hitting that 15.3% record EBITDA margin through sheer cost discipline. 2. The Stickney facility closure mathematically guaranteeing a future EPS boost. 3. That massive $300 million cumulative free cash flow target. 4. The secular unstoppable tailwinds from AI-driven utility grid demand. 5. Slashed capital expenditures maximizing immediate cash generation. 6. Share repurchases being executed at levels that imply a deep discount to intrinsic value. And finally, 7. Consecutive double-digit dividend hikes rewarding patient shareholders. Now, being the skeptics we are, we have to verify that this margin improvement is actually, real. If you look closely at the adjustments for impairment, restructuring, and plant closure costs on their unaudited reconciliation, it hit over $51 million for the year. These filings verify that while their standard GAAP net income gets absolutely hammered in the short term by transition costs, the underlying adjusted EBITDA improvements are mathematically sound. The operational core of the business really is genuinely getting leaner and significantly more profitable. So let's synthesize all of this and get to our final verdict. First, if we were to run Koppers through the ultimate valuation gauntlet, applying standard discounted cash flow and dividend discount models, the sheer cash flow metrics and that projected 10 to 15% free cash flow yield point to a stock that appears broadly undervalued relative to its underlying cash generation capabilities, even with those declining sales. Second, let's define their economic moat. They possess a narrow but highly stable moat built heavily on efficient scale and deep material science expertise in some very niche markets. The high barriers to entry, you can't just easily spin up a chemical wood treatment plant in your backyard, combined with their strategic transition away from volatile carbon materials toward higher margin utility products, suggests this moat is actually gradually expanding over the next 3 years. Third, here is the nuanced takeaway. Koppers is successfully executing a painful but totally necessary internal transformation. A legendary investor like Warren Buffett might actually love the expanding moat and ruthless cash flow discipline we're seeing, even if Benjamin Graham would immediately balk at that 3.5 times net leverage ratio. They are intentionally shrinking their revenue footprint to drastically expand their profitability and free cash flow. The models are pointing one way, but hidden flags suggest a storm. Which side are you on? Do your own homework.